Hi. Today we picked our fraud case over Nortel Network Corporation, which is a telecommunications company in Canada. Um, and my teammates are Yuli, Elizabeth, and Jake. And so at first I'm going to go over the timeline of the corporation. And yeah. Okay, at first, in 1895, Nortel, aka Northern Electric, which had changed its name, but so the first part of the business opened in 1895, and it was a sect of the Bell Corporation, which it was the Canadian sect of Bell Corporation, which Bell Corporation actually is AT&T now today. Yeah. And then, so 1998 was when the corporation changed its name to Nortel. Yeah. And then 2000 was a really good year for Nortel, and this is when they hit their market high and their highest stock price at $124.50 Canadian dollars. 2001 was when they changed the leadership in the corporation, and Frank Dunn, was the old CFO, was promoted to CEO and replaced John Roth. And then in 2004 was when the fraud kind of came to fruition, and they fired both CEO Frank Dunn and CFO Douglas Beatty. And then in 2010 was when the civil charges were filed by the U.S. Securities and Exchange Commission against four former executives of Nortel. So industry and background. So we wanted to go over the fraud that was committed by other corporations in the telecommunication realm, and so we thought the same thing happened to WorldCom, and I just kind of went over. I'm gonna go over a little bit what happened with WorldCom. Since it was such like a boom or bust economy in the late 90s to early 2000s, a lot of people were trying to inflate their stock prices to be able to make their stock options more viable. So what WorldCom did was what they got caught from doing was they classified $3.8 billion from line costs to capital expenditures, which would decrease their current expenses, which then would increase their net income, and then it would also increase their assets. So I saw a lot of similarities between these two companies, especially because their sole purpose was just to boost revenue. And here's Jake to talk more.
Okay, so Nortel engaged in two incorrect accounting schemes, the first one involving revenue fraud and the other involving earnings management fraud. The revenue fraud accelerated material amounts of revenues into the year 2000 when it should not have been, and created the false appearance that Nortel was weathering an economic downturn better than its competitors. Nortel responded to those market pressures by engaging in a fraudulent accounting scheme that did not follow U.S. GAAP rules. The scheme involved bill and hold transactions, which Nortel had given the appearance that it had banned, and these transactions enabled Nortel to recognize revenues on idle inventory sitting in warehouses. So this kind of meant that Nortel accelerated more than 1 billion revenues to meet Wall Street's expectations. The earnings management fraud reduced or increased Nortel's earnings as necessary to create the false appearance that Nortel had stabilized its operations and returned to profitability. So Nortel publicly announced that it expected to return to profitability by the second quarter of 2003. But internally, the company had made a different decision that it would return to profitability in the fourth quarter of 2002. So as it internally determined a separate time frame, it established and maintained unnecessary reserves in order to reduce earnings for the quarter and avoid reporting a profit earlier than it publicly predicted, and then add to those existing reserves so it could release those in the future to improve its financial results. In 2003, the market turned out to be rockier than they had expected, and they improperly released some of those reserves to allow the company to report a profit instead of a loss. This happened for the first two quarters of 2003, and that ended up triggering bonus payments to Nortel's executives.
The three most influential people in the Nortel fraud were these three former executives: Frank Dunn was the CEO, Douglas Beatty was the CFO, and Michael Gology was the controller. These men were accused of deliberately misrepresenting the financial statements by inflating profits so that they could continue to receive their bonuses, which added up to about $12.8 million throughout 2000 to 2004. The company was declining, but instead of having the stockholders' best interest in mind, the executives used aggressive reporting to maintain their bonuses. The stockholders lost close to $400 billion when Nortel filed for bankruptcy soon after. The 3 executives were criminally charged, but all were acquitted and avoided 10 years in prison. Their acquittal potentially sends a message to other financial reporters in Canada about the lack of enforcement in this area. This creates a culture of dishonest, or at least not completely honest, financial reporting and the idea that perpetrators can get away with it. Also, Mary Ann Pafil served as the assistant controller and VP of corporate reporting. She, along with the other 3, were served civil charges by the SEC, however. This case was settled in 2007 for $35 million.
So after everything kind of went down and the main executives were fired, an interim CEO kind of took the role for a little while, and then finally they hired Mike Zifrowski, who actually used to be the former CEO of Motorola, to be Nortel's new CEO. A little bit afterwards, about a few executives actually returned some of their bonuses that they were given because of the erroneous accounting. Also at this time, Nortel is actually not performing like super well, but they actually had one more merger with LG Electronics, which they acquired. A little bit after this, Nortel settled the civil case with the SEC for about $35 million. And then in 2009, Nortel filed for bankruptcy protection a day before they had a $107 million interest payment due. Nortel said that they did not plan on emerging from the bankruptcy and would be selling all of their units. Now, after 4 years, Nortel executives were found not guilty for fraud, and the court ruled that the events were a result of human error. Now we're going to watch a short video to summarize what we all just said.
They were accused of orchestrating a multi-million-dollar fraud in what was the largest white-collar criminal trial ever to take place in this country. And today, 3 former executives of Nortel were acquitted on all charges. Millions of Canadians lost money when Nortel collapsed, and 90,000 employees lost their jobs. Jacques Bourbeau has more on the verdict and the reaction.
It was a high-flying, high-tech company. But in 2009, Nortel flamed out, declaring bankruptcy. Sifting through the wreckage, prosecutors laid fraud charges against 3 former executives. But today, a judge found them not guilty.
I'm very happy. Thank you very much.
The defendants had little to say about the verdict, but they were clearly relieved. Prosecutors said billions of dollars were set aside in a kind of cookie jar to deal with future expenses. But in 2003, some of that money was withdrawn and put on the balance sheet, turning what would have been a loss into a profit. And that triggered $12.8 million in bonuses for the 3 executives. In his ruling, Justice Frank Morocco said, "I am not satisfied beyond a reasonable doubt that the defendants deliberately misrepresented the financial results of Nortel."
We're ecstatic with the results. It's a great judgment and complete vindication of Mr. Beatty. There was no fraud at Nortel.
This business professor says the judge made the right call.
There was evidence before they were even charged that the accounting firm of Deloitte, which is a highly professional accounting firm, was signing off on the very activities of the executives that the Crown alleged was fraudulent.
This former Nortel employee came to the courthouse to hear the verdict.
I have worked with them. I knew that they followed standard practices for accounting, and I did not think that they would be found guilty.
Nortel's bankruptcy has hit many retirees hard. Their pension benefits cut by 30 to 50%. and they feel let down by those who once led them.
There is some level of hard feeling about where the executives over a course of a period of time took the company or didn't take it. And so there's that level of bitterness.
Lots of factors played into Nortel's demise: the dot-com crash, accounting scandals, big debts, and falling sales. But today, a judge concluded criminal activity was not among them. Jean Perbeau, Global News, Ottawa.
Before its downfall, Nortel was by far Canada's most valuable company. At its peak during the tech boom in 2000, Nortel was valued at nearly $400 billion Canadian. It dwarfed other Canadian companies back then, representing 1/3 of the value of the TSX. And just by comparison, Canada's most valuable company today is Royal Bank at $89 billion.